Welcome back to the Loan Lads. Last episode we talked about construction loans. Today we're going to dive into rental properties.
So today we're talking about DSCR loans, and no, it's not a new cryptocurrency. It's a loan for real estate investment properties. That's what we specialise here at Park Place Finance, along with our construction loans. We are a nationwide hard money lender.
All right, so what is a DSCR loan, Joe?
So as we know, it's not a new cryptocurrency. DSCR stands for Debt Service Coverage Ratio.
So is that just a fancy way of saying that your rent covers the mortgage, right?
Exactly, yeah.
So lenders use debt service coverage ratio to verify that your income, your rental income, is going to cover the debt on the property, and then hopefully that's where you're also going to have profit on the backside of that, right? And that's kind of the whole point. Most people use DSCR loans or rental properties, specifically residual income, right? They want to make that passive income month over month. So you see a lot of investors nowadays try to pivot to this model, whether it's the BRRRR method, which we'll get into in just a little bit, or it's just buying turnkey ready properties, meaning you're buying a property that's ready, right? And the goal is to just put a tenant in there and ensure that you're going to make profit on the other side. As we know, the market's got a little bit tougher, so finding properties that have lower taxes, insurance costs isn't too high, but the rents are still higher, right? They've got kind of above market standards on that side. That's where you're going to make the profit.
Yeah, for sure. And when you're talking about profit, you're mainly talking about cash flow there, right? So basically when the rent is covering your principal, interest, taxes, insurance, and any HOA fees that may be due on the property, the profit part of that is where your rent covers all of that plus some, which a lot of people call as cash flow on a property.
Cash on cash return is a term we use in our world a lot, especially with investors. But what would you say is kind of the main reason an investor would want to do this, like buy a rental property or use a DSCR loan specifically?
Yeah, absolutely. I mean, first, I think we should talk about why someone would want to buy a rental property. For building wealth, buying up rental properties and building that portfolio of cash flow and rental properties is really what a lot of people talk about to become financially free, to where instead of doing your 9 to 5, you're actually buying these rental properties. After X amount of years, your cash flow increases, right? Your cash on cash return increases because the principal is dropping because you're paying that off, right?
Yeah, so these rental properties could be anything from multifamily, single family, duplexes, triplexes, or it could even be commercial properties, right? Retail space, office space, industrial, anything that you can rent out to a tenant at the end of the day is a rental property, right? At Park Place specifically, we don't get into the commercial game as much as we would love to.
Right.
We focus on residential, but there are lenders out there who do it. We prioritize single families, 2 to 4 units, and then multifamily 5+ properties. And that's kind of what our specialty is in the space for DSCR loans specifically. I think it really depends on an investor's appetite and then their market on which one they're looking to get into. For example, in Austin right now, multifamily sector is a little bit better because for the single family side, the taxes are so high for a single tenant occupancy, you're not going to typically be able to cover that debt service coverage ratio with the rental income, right? You might be able to, but a lot of it can't in today's day and age. However, if you go get a multifamily property, let's maybe say it's 8 units, you're going to be able to cover that and you're still going to be making that residual income.
For sure, yeah. That's a great point. Even though single families can be a fantastic way to actually get into the rental game, really the end goal is to get up to that multifamily stage to where those returns are typically higher than your single family. Now, that's not to say that having a big single family portfolio of rentals isn't a great strategy, because it is. We see it time and time again. But personally, I would think the end goal would be to get into the multifamily space.
Yeah. Let's talk about what it takes right now. Like what type of loans are out there for rental properties? There's a couple different sides of the business. You've got your non-QM, which I would say is most broadly known, right? A lot of people go to the non-QM route. It's more of your conventional style loan, the way it's been underwritten and the documentation needed. You've got bank statement loans, and then you've got the DSCR loans, right? And the big difference between kind of the DSCR versus bank statement non-QM is the qualifying factors.
Right.
So for a non-QM loan, you're typically, a lender's going to ask you for your tax returns, your W-2s, so they can see what you're actually making per year. They're going to look at your DTI. It's a heavy doc loan. It's almost like a conventional underwrite. Right.
Correct.
Bank statement's a little different. They're looking at the actual money in your account, right, at the end of the day. Whereas a DSCR loan, we're underwriting the asset itself, kind of as we talked about in episode 1, just hard money in general. We're underwriting to the asset, and then the borrower to qualify, they just have to have a credit score above 640. And typically, it depends on the lender you use, but let's call it 640. And then you got to have enough in your bank account for either the down payment if it's a purchase and reserves, or if it's a refinance, just reserves alone. And if you're getting cash out, typically you can use cash out for reserves.
Yeah, for sure. That's a great point. I get a lot of people a lot of the time asking me why I should use a DSCR loan over, say, a conventional loan. The main reason is that DTI, right?
Yeah.
So a DSCR loan is not qualifying based off personal debt to income. There's always a cap on those as well. A lot of conventional lenders will cap you at X amount of properties, whereas the DSCR loan, since it's asset backed, since it's based on the performance of the asset, not the individual, those are endless, right? You can take out as many DSCR loans as you qualify for, but those are endless because it is based on the asset itself. So
yeah.
So Connor, why do investors love the DSCR loan for building their rental portfolio?
Yeah, so touching back on what we just said, the first thing is no W-2s or no income verification. So those are the two biggest ones. Also, it's great for scaling, right? Because again, like you just mentioned, there's no cap. You can get as many DSCR loans as you need because at the end of the day, the properties are covering the debt. Another reason would be that investors can qualify quickly and close quickly. So these are typically anywhere from like 2 weeks to 4 weeks max to close. Most of the time we see about a 2 to 3 week range for closing time versus a non-QM loan that maybe takes 45 to 50 days, call it, maybe even 60 days sometimes. I would say that those are the biggest reasons as to why an investor would use a DSCR.
For sure, and we touch on investor, right? A lot of investors use real estate to make their income, right? That's how they put food on the table. So a lot of these investors don't have your standard W-2 income. They have income from multiple different sources, which is typically not traditional income, a lot of people would say. And it's much harder to qualify conventional when you don't have that traditional W-2 income, where the DSCR loan, again, we keep touching on it, does not require any W-2s, tax returns. It's based on the asset itself. So the flexibility of different types of income to still be able to buy those rental properties is super beneficial for investors that do this for a living.
Yeah, so you're talking about like entrepreneurs or self-employed business owners who maybe don't have those W-2s to verify. That's how they qualify with these loans, is because, again, it's asset-backed, and then they're just showing their bank statements for reserves.
Right, exactly. Let's touch on like the property itself, because on a day-to-day basis, people may not really understand what the DSCR loan is there for. Yes, it can be a 30-year fixed, it can be a 5-year arm, we can do interest only, there's prepayment penalties, we'll get into all this. But really, what type of property qualifies? And the real answer is it's a stabilised property. Yep. So when we're talking about stabilised, meaning that there's no deferred maintenance, there's no rehab that's needed to the property, it's really rent ready, right? So if tomorrow you got a tenant in place, they could actually go in, move all the stuff in, start living, and start renting that property from you, right? And the reason for that is the loan is specifically made for long-term rent, and there's no rehab component to these, unlike the fix and flip and ground-up construction loans, right? It's not meant for a bridge between a gap because it is stabilized, and it's really, you're at your end game of what you're trying to do with that property, which is to hold it as a long-term investment and cash flow on that property.
Yeah, and the word we always like to use is turnkey ready.
Yeah,
that's what you're going to hear a lot of realtors say, a lot of other lenders use as well, but it's kind of the word we use for those stabilized properties is turnkey.
Yeah. So I know we've touched on to qualify for a DSCR, the rent has to cover the debt. What type of rent can actually cover? Because there's different type of rentals. There's short-term, there's Section 8, there's long-term rents. I think we should dive deeper into what rents qualify and
So on the rental side of things, if a property's occupied, we'll get that lease agreement from the client, right? So we're going to verify that, make sure that they have deposits coming in. And if they do, whether it's short-term rent or long-term rent, we'll use that. On the short-term side, if it's called a refinance, we always want to verify that there's at least 12 months worth of income history, right? If not, we'll still use short-term rental data. We're just going to go through third parties to verify what that data is based on market. Very similar to like if a property is a long-term rental but it's vacant, we're going to pull the market rent, right? So we've got third parties who do that. You can have appraisers do 1007s. There's multiple different ways to track down what the market rent of a property is. So that's how we're going to verify it on either the short-term or long-term side. Another one that's become very popular in today's day is Section 8 rents. So what we'll do is typically those Section 8 houses either have they're pre-leased or they have an agreement and they basically are guaranteed X amount, right? So we're going to verify that with that documentation and then base the DSCR ratio off of that income.
For sure. And for an investor that's maybe listening, what's the best way that they can verify rents or really get a good estimated idea of what rents are going to be for that subject property before actually getting themselves into contract to where they're putting earnest money down, or maybe they're doing the BRRRR method and they want to kind of preempt what that market rent would be to make sure that on the exit, if they are planning on refinancing and holding, that the property will meet that one-to-one DSCR?
Yeah, that's a great question. There's a couple different sites. Redfin and Zillow are like your best friend, right? At the end of the day, they're very user-friendly. What I do personally and what a lot of our clients do is they'll go to, let's call it Zillow. Let's say we're talking about the Austin market. They can go look in Austin for maybe they're buying a 3-bed, 2-bath house, right? They can go look at 3-bed, 2-bath house and kind of that somewhere in the range of square footage that they're buying, and they can look at what every property is rented for in the same zip code in the immediate area and get a really good feel for what's actually, listed for rent in the area, so you understand fully what's out there. You can also get with your realtor, whether you are a realtor yourself or you have a realtor. They can also pull market rent from the MLS, so they can see what other properties have rented for to give you a good idea.
Yeah, absolutely. What would you say to someone that has the question, rents fluctuate in my subject market, right? Let's say rental as of today is $2,000, but then maybe it drops to $1,900 within the next year. What would you say to that client, and will Park Place or will any DSCR lender always continually check up on what you truly have that property rented for?
Yeah, so we're always not going to check up on what you have the property rented for. At the end of the day, once we get the loan for you, if you ever come back to us and you have concerns, we're always willing to help, right? But it's not something we're going to call you every year and be like, what are you renting for the property now? We don't like to micromanage. We want the investors to make their decisions ultimately, since we underwrote the property originally. Now, what I'll say on maybe it's a market where the rents are declining, if you don't own the property yet, I would tell you to take a deeper look into that market, see if that's been a trend for the last 3 years or maybe 5 years. Because if it's declining, let's say from, like you said, 2,000 to 1,900 over a year span, I'm going to look at the year prior, right? Because if it's a trend and it's continued to go down over, let's say, the last 3 years, that's probably not somewhere I'm going to buy. Absolutely. However, if it's maybe stabilized, it's been stabilized, and you're lowering your rent to maybe get more competitive because your house has been on the market for rent for a while, or maybe everything around you is starting to drop and you want to relist it when your lease is up and make sure you get a tenant in there quickly. As long as it covers your DSCR, go for it. And even if it doesn't, right, DSCR ratios can go down to 0.75, meaning that you are not covering 100% of the payment. If that's your strategy as an investor, then at the end of the day, we've talked about it all the time. Know your exit strategy and know your investment properties, right? So if you have that appetite, go for it.
Absolutely. And it can work in the other way as well, right? On the appraisal or what the lender deems as the market rent of the property, that doesn't go to say that the investor can't go out once they've purchased it and list it for, you know, $500 over, if they can get it rented out for that, then kudos to them. It's really not, again, we don't micromanage how the investment property runs. We underwrite to what a conservative market rent analysis of that property is, to make sure that really worst case scenario, that's what we're looking at, is still going to actually work in terms of that rental property there.
Yeah, I think also too, like you mentioned, we see it a lot, especially right now in today's market, where investors will go get a market rent on an appraisal 1007, right? And let's say you're in Atlanta, Georgia, and the market rent comes back at 4,000. We'll see a lot of times that they've got leases for $5,500. Maybe they're close to a park. Maybe they're in walking distance to a shopping center. Maybe they're at some form or fashion, they have some attraction that is willing to bring a renter in, and the renter is willing to pay that price because of a certain amenity. It could be an amenity in the house, or maybe they got a pool or something that all of the other rental properties in the area don't have, or it could be proximity to something in the immediate location.
Yeah, absolutely. That's a great point, because how we look at rent and how appraisers look at rent is really an average of what the market looks like, right? They will pull a couple of comps for rental properties in that area, but for rentals, like you said, there's a bunch of different small nuances that can increase rents, can decrease rents. So yeah, absolutely. The more you can get for your rental property and the more someone's willing to pay, the better that is for the investor there.
Yep.
So the BRRRR method, what it stands for is buy, rehab, rent, refinance, and repeat. And it's a real estate strategy of basically building forced equity, pulling cash back out the property, renting it long term, and then using that capital to move into your next project.
Yeah, and so we see that a ton now, kind of touching on the original. People are buying these distressed properties. They're doing the touch-ups, they're making the property rent ready, but also making those specific amenities or attractions that will bring in a renter that's going to help cover that debt to income, but then again make them profit on the back end. So they're kind of getting both sides. They're getting their cash back as long as there's profit in the deal, and then on top of that, maybe they're renting it out for $2,000 and their monthly payment's $1,500. So now they're going to make $500 per month, cash flow. So that is the main strategy we see in today's market, and it's great. I think it's a huge key part of investors building a multitude of wealth, whether it's residual income or passive income.
Yeah, absolutely. It's such a powerful investment strategy. Reason being is you can start off with your initial investment, which would be the down payment into the first subject property. Then you're using our financing, like the fix and flip loan, to where you're doing rehab to the property, which is causing that forced equity. Then at that point, let's say, you do your rehab and then it's worth 100,000 over your cost basis. Well, then the then the lender like ourselves, we can finance up to 75% of that new value. So you are able to pull some of that equity back out the property and use it for your next down payment. So it's a real way of building wealth and building that rental portfolio without having to continuously build up a capital stack to then put into your next investment as your down payment and then move on.
Yeah, so kind of to plug in Park Place here, Park Place is your end-all be-all lender, right? We can do both sides of that. We can do the front-end renovation loan, help you buy the property and renovate it, but then we can also do the back-end loan of the DSCR to help you refinance it into a long-term rental property.
Absolutely. And then what I would also say is super powerful about the BRRRR method is you can keep some of that forced equity in the property, right? So you don't really have to refinance at the full 75% and pull all the cash out if you don't need it. It actually gives you the opportunity to maybe refinance at a lower LTV to where the DSCR makes more sense, to where you get an actual more cash flow compared to when you go in straight and buy a rental property. You're really trying to buy at your max LTV there. Otherwise, you are putting more equity into the deal.
Yeah, fully agree. All right, so let's talk about the pricing side of the DSCR model, Joe.
Yeah, for sure. So first off, me being on the front line as a loan officer, I get asked a lot of times, well, why would I go with the DSCR loan compared to the conventional in terms of pricing, right? Because your conventionals are typically 1% lower than what the DSCR is. And the answer is everything that we've just mentioned, right? All the flexibility and so on. of that product. Now, the pricing is definitely much lower than those short-term loans because it's not a quick in and out, and it's around 1% higher than your conventional loans.
Yeah, so I think rates fluctuate, as everybody knows, on the conventional side as well. They're tied to the same structure. So we see rates fluctuate on a monthly basis. Right now, you can get as low as about 5.875 roughly. We're seeing most stuff come in the mid sixes. And it depends on how you structure, right? So that's the lucrative part about a DSCR loan is you can buy up or down the rate, right? Yeah. So if you want the lowest rate possible, we can get you there. You just got to pay more in points, right? Mm-hmm. We can also get you, the par rate and get you at 0 points, which is what a lot of lenders want, or investors want to do. They don't want to pay any closing costs besides your title and insurance fees. We can get you there. That's not a problem. It's just going to be at a higher rate, right? So it depends on what your flexibility is and kind of your appetite. If you want the lower rate, we'll get you in the door, but it's obviously going to be at a higher cost. All right, thank you guys for tuning in on episode 6. As you can see, we're already filming episode 7 here, where we're going to have a special guest, so make sure to tune in next week.